A petty cash fund is a small amount of money kept on hand by a business to pay for small expenses without writing a check, as it is too time consuming. These expenses could include office supplies, snacks for meetings, postages, and other miscellaneous expenses. The size of the petty cash fund depends on the need of a business. Generally, it is small enough so it doesn't become a target of theft, and large enough to reduce the inconvenience of replenishing the fund too frequently. When using petty cash funds, there are three activities involved. First, establishing the fund. Second, making payments from the fund. And third, replenishing the fund. To establish a fund, a company must first decide how much money they want to put in the petty cash fund. The petty cash fund is established by writing a check for the amount of fund, then cashing the check and giving the cash to a custodian who is responsible for the safekeeping of the cash. At the time the fund is established, a journal entry is needed. Let's say a company establishes a petty cash fund of $300. We will debit the petty cash and credit the cash for $300. What's happening here is that the company is writing a check for the $300 and cashing it from the bank, allowing them to have a petty cash of $300 in hand for small expenses. The next step is to make payments from the fund. The payments can be made from either 1, taking the cash from the petty cash fund from the custodian, or 2, employees can seek reimbursement from the fund in situations where the money is used to purchase items for the company. In both cases, the custodians are responsible for distributing the cash and collecting the receipt. The final step is to replenish the fund. So as the cash in the petty fund decreases, the fund must be brought back to the original amount. To do this, the custodian must count the remaining money in the petty fund. To ensure that there are no errors, the total receipts and the cash remaining must add up to the original petty cash fund. The business must prepare a check for the amount of money needed to bring the petty cash back to the original level. At the same time, the receipts are removed from the petty cash box and officially recorded as expenses. A journal entry for replenishment is then made. All the expenses are debited and the cash is credited. The cash is credited since a check must be written to replenish the fund to its original amount. The custodian then takes the check to the bank to get the cash for the petty fund. Sometimes, when the custodian reconciles the petty cash at the end of the month, the amount of cash needed for replenishment and the total amount of receipt don't add up. This could be a result of summing error, or more commonly, someone failing to provide a receipt for an appropriate expenditure. In either case, the available cash must be brought to the appropriate levels by debiting the cash over and short if there is a shortage of money, and crediting if there is an overage. A shortage is recorded as an expense, whereas an overage is recorded as a revenue. In our example, $242 is to be replenished even though our receipts show that $220 of expense was made. This results in $20 charge in the cash over and short account, which means it has been debited and recorded as an expense. Thank you for watching.